Hi everyone, welcome to this month's Fixed Income Outlook. I'm Shalini and with me today is Devang Shah. Together, we will review the key macroeconomic developments of November 2024 and discuss the implications for fixed income markets and investment strategies. Devang, let's start with the global macro landscape. What are the key highlights from November?
November was marked by significant global events, particularly the complete red sweep in the US elections. This has raised a few near-term concerns, which are the impact of tariffs on China and rest of the world, the trajectory for US inflation and Fed's rate cut cycle, and the implications for emerging market flows, currencies, and monetary policy.
These are certainly important factors. How did the markets, particularly bonds and currencies, react to the red sweep?
Surprisingly, bond and currencies, despite a complete red sweep, did not react much, as Trump trade was largely priced in, which is both dollar strengthening and rise in yields happened last month. US yields, in fact, fell by 15 basis month on month, and crude oil prices and dollar traded within a very narrow range as markets await the timing and execution of Republican policies. Also, weaker than expected policy announcements from China added pressure on crude and commodity prices.
And what about the Fed's actions? Any surprises there?
Not really. The Fed continues with a 25 basis point cut in November also, bringing the total rate cuts this year to 75 basis points. We expect them to deliver another 25 basis point cut in December, making a cumulative of 100 basis point reduction for 2024. I think what would be interesting or markets would be keenly tracking is the Fed rate cut trajectory for 2025.
Now let's shift our focus back to India. What were the major macroeconomic developments here?
In India, back home, there were three key major developments in November. I think first foremost, banking liquidity entered into a deficit zone due to a sharp reduction in core liquidity caused by FX outflows. Secondly, I think the GDP number which got released came as a shocker at 5.4%, significantly lower than expected due to weaker capex, reduced government spending, and slowing consumption. CPI again for the month of October was at 6.2%, exceeding expectations primarily driven by higher food and vegetable prices. Yes, it was higher than the RBI comfort zone, but we expect inflation to be lower next month.
Well, that's quite unexpected developments. How did the bond markets respond?
Bond market yields did show some volatility for the month, but month on month, if I look across at them, they've rallied 5 to 10 basis across the curve in anticipation of RBI action to address a tight liquidity and GDP slowdown. We believe that first, slowly high frequency indicators, weak Q1, Q2 GDP, and a muted festive season suggest that RBI may revise its GDP growth forecast for FY25 down by 40 to 50 basis points. December's monetary policy will be a critical one. We believe RBI might prioritize addressing liquidity deficits and slowing growth over near-term concerns like inflation and currency depreciation. A 25 basis point CRR cut or policy rate cut could be on the card.
Interesting. Let's move on to fixed income strategy. How are we positioning our portfolios and what is our outlook?
Since March 2024, we have been advising and maintaining high duration across all our funds. And this approach has worked well. Some key points, we've already seen over 50 basis point of rally in 10-year bonds this year. And a favorable demand supply dynamics and expected rate cuts could add another 25-30 basis point of rally over the next 3 to 6 months. Banking liquidity is likely to remain in deficit during Jan to March 2025 unless RBI intervenes with VRR auctions or some CRR cuts. This deficit liquidity could lead to higher operative rates and increase some volatility in money market yields.
Sounds good. Now what's your view on asset allocation?
We continue to favor government bonds and our duration funds due to the favorable demand supply dynamics. India's growth remains still relatively strong. Hence, we don't expect RBI to be very aggressive in cutting rates. That said, we anticipate a total of 50 basis point rate cuts over the next 6 months, with every policy meeting live for potential action.
What are the risks to your view?
The primary risk for our markets is currency depreciation. A weaker INR could delay rate cuts or reduce the quantum of rate reductions, potentially impact long duration strategies.
What would you recommend investors in this environment?
Investors should continue holding duration across their portfolios, but should realize that incremental gains in long bonds will largely materialize post-rate cuts. the December policy meeting for some reason doesn't deliver a rate cut, we could see near-term volatility or rise in yields. However, we expect 10-year G-Sec yields to move closer to 6.5 in the next 6 months. We recommend short to medium-term funds with a tactical allocation to gilt funds, aligning with our core macro.
Thanks for the detailed insights, Devang. That was very comprehensive.
My pleasure, Shalini. It's always great to share updates with you, and let's see how the macro situation evolves over the coming months.
Absolutely. Thank you all for joining this month's Fixed Income Outlook. See you next time.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.